This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 5 a.m. in New York, 10 a.m. in London, and 5 p.m. in Hong Kong. Our top stories today. China sets up a task force to examine risks and potential debt after one of the nation's top private wealth managers missed payments on multiple investment products, alarming investors with fresh anxiety about the health of the shadow banking industry. Goldman Sachs pencils in the first Fed rate cut. Economists are anticipating the central bank will start lowering interest rates by the end of next June with a gradual quarterly pace of reductions. We're going to dive into what that means for the market shortly. And U.S. Steel rejects a $7 billion takeover offer from rival Cleveland-Cliffs. It promised to create one of the world's biggest steel makers, but U.S. Steel calling the bid, quote, unreasonable. Welcome to Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Danny Berger is off today, a well-deserved vacation. Let's get a quick check on these markets, though, because a really interesting dynamic playing out on this summer Monday, we'll call it. Let's start over in Asia, essentially what happened overnight, because you are seeing a broad sell-off in the Asia-Pacific region, to the point that you see the MSCI Asia-Pac index down about 1.2%. But the real underperformer here is going to be China, and you can already see that in the Hang Seng index, down about 1.6%. This is an index that just won't catch a break. What's important to note about this is it's really affecting sentiment around the world. So if you actually look at the S&P 500 or the European stock 600, it actually kind of mirrors the sentiment you are seeing in China. Now, of course, it is seen as the alternative when you don't have that much of a bid into the Chinese market. But trend-wise, you are still seeing the same thing in the global equity indexes. Let's get to the currency market, though, because dollar yen actually retreating a little bit. It hit a 9-month low of 145 on that currency pair. Continued weakness for the Japanese yen as we again talk about simply what the BOJ can do, whether they can really deal with those inflationary pressures, which, to be fair, they've actually been wanting for the past, couple of decades. Interesting dynamic there. Nevertheless, dollar yen 144.93, kind of unchanged on the mark, but again, pulling back from that key level of 145. Let's look at copper, though, because, again, we are seeing red on the screen, but not by much. 371 on those copper futures. What's interesting to keep in mind is that overnight, even as a lot of Asia was selling off, copper was actually higher. And that's an interesting trade, given the kind of cross-asset dynamics there. Let's go from Asia over to Europe, because, again, speaking of that dynamic, here's where you see the divergence. Stocks Europe 600 up by 0.2%. So that Chinese sentiment not really playing as much into the European story. A real outperformer there is going to be that German index, the DAX, higher by about 0.5%, we'll call it. But even the Boon market getting a little bit of a bid, and I think that's going to really play into the U.S. story. We're going to check that in just a moment. But again, it comes down to commodities, as for Europe it has for the last year or two. Natural gas futures coming out of Netherlands higher by 2%. The strikes that you are seeing in Australia having a real effect on just how much supply Europe can get. And remember, this really matters as we talk about the forward contracts. It is getting cold in Europe. It is getting chilly, and that means that you start having to price in what that winter supply looks like. So that's going to be a story we dive into in the rest of the show. Let's get to the U.S. here, because that green on the screen is actually translating to the U.S. session. You are seeing futures higher by about 0.2% for a radio audience, 44.87 on those contracts. But again, the outperformer in the U.S., and again, be fair, it's only been about an hour of individual stocks trading higher. The NASDAQ 100 futures higher by about 0.3%. So again, right out of the gates on this summer Monday, a little bit of a bid into the tech space, and I would argue a slight bid into the bond market as well. Although if you look at the 2-year, the 5-year, the 10-year, the 30-year, not a ton of action just yet. Does that change as we get more information throughout the day? And of course, Brent crude, our obligatory check, an 86 handle on that commodity, down about 0.6%. Again, this makes sense as we talk about that pullback you are seeing in all of Asia, which brings us full circle to our top story today. China's banking regulator has set up a task force to examine risks at one of the nation's top private wealth managers. This comes after a unit missed payments on multiple high-yield investment products. The looming crisis in the Chinese property sector, it's weighing down the country's economic recovery. Joining us now is Bloomberg's Sphia Salim. Sphia, you are an expert on all things China. You are now based in London. Let's really tap into the expertise here and talk about this property sector, specifically through the lens of the Country Garden story. Simplify it for us. How worried should we be?
So Country Garden, just to put it into context, when people ask me, Kriti, is this the next China Evergrande? Should we really be worried about contagion here? Country Garden used to be China's biggest property developer by sales. The difference with Evergrande is that this is a much better run company. It was rated investment grade as recently as June last year. This really shows how it's a liquidity issue, a cash flow issue, rather than a bad debt management issue. So Country Garden does have cash on hand. It will probably use that cash to finish, to make sure that it delivers home projects that are being built. That was one of the key issues last year when we had those protests across China on unfinished homes. So we will see kind of a different story being played out here. The difference, or what's worrying markets really, is that if this can happen to Country Garden, how deep is the crisis here? This is a company that was seen as a survivor in the market. It's also much more exposed to China's kind of low-tier, smaller cities than Evergrande was, which is not the focus of China, of stimulus and of support from Beijing right now. Beijing is, of course, trying to kind of manage the downturn in the property market. It is engineering this. This is something that Beijing wants to happen. It does want the property crisis, the property market to drop, but drop in an orderly fashion. And I think, Kriti, that is proving a lot harder to do than Beijing had anticipated.
I'm so glad that you brought this up as kind of a case study on the broader property market, because this is one of my big questions sitting right here in New York and not necessarily monitoring the tick by tick moves. As we talk about kind of whether Country Garden or Evergrande is a kind of harbinger of what's to come when it comes to the broader property market, it feels like the, I don't want to say excuses, but the kind of defenses of each company is simply that, well, this is a isolated issue. This is a very specific to the way this or that company operated. How long do you think, in your professional opinion, will it take for this kind of full domino effect to play out in the Chinese market? And when can the Chinese government perhaps get ahead of it?
I think that's a really good question, and that is really, at the center of why the market fell so much in Hong Kong and onshore China today, is because of this fear of contagion. Because it's not just the property developers. These are the Evergrande, the Country Gardens. These are the companies that build homes. We know that there's a demand problem there. There's also a cash flow issue because these are incredibly capital-intensive companies. But what we saw today, kind of in the middle of all this, all at the same time, was this wealth manager that failed to pay what it owed on trust products. Now, I'm not going to go into very kind of deep minutiae here, but wealth products or trust products are essentially what wealthy Chinese invest in. So it's, these companies pool all this household capital. It's about $3 trillion, so it's not a small industry. And then they invest in usually high-risk investments because they need to kind of deliver high yields. And this company was exposed to the property market. Now, this is where the contagion happens. It invested in the property market. About 11% of its assets are exposed to that industry. Last year, because it was expecting, it was betting on a recovery. Now that recovery is not coming through. I think that's what's surprising, not just people in China, but people outside China. Is we did see this kind of change in policy out of Beijing more than a year ago now, and it's not helping. So what could Beijing really do if it does want to turn around this market? If things start looking a bit uglier than they are now and they start kind of infecting the rest of the economy, what levers can China pull? And I think that's what's really making people nervous now.
I'm so glad you mentioned that. Again, in our last minute, Sphia, one of my favorite kind of fun facts, I always throw it at Danny when her and I are anchoring together, it's simply that if you compare this to some of the other kind of Chinese crises in the past, I love to look at 2009 simply because of the massive infrastructure investment they made, which had a real read-through into the rest of the global economy. There are some folks out there who say the recovery that we saw in 2009 in the U.S., in Europe, post-global financial crisis came from that massive infrastructure investment. And I'm just wondering, as you look at kind of the contagion effect, of course, within the country of China as well, how does it kind of filter through to the U.S., to Europe? Is there a real read-through, just given the sector is so different from anywhere else in the world?
Yes, and I do think a lot of people were expecting that to happen, and this is the kind of the danger with looking at history. History does rhyme, but it doesn't repeat itself. And when it comes to China, those lessons from 2009, what China did to engineer that recovery was really kind of pump debt into the financial system, and it's dealing with that debt hangover now. I mean, it's trying to diffuse risks in the financial system. What happened with infrastructure spending, building bridges, building airports? There's only so many airports you can build, Kriti. That is no longer something that China can do. It no longer makes sense, and you have this kind of excess capacity as well. So there's no easy fix when it comes to growth. Not just that, but Beijing also wants to pivot that growth. It no longer wants to, first of all, rely on infrastructure as the key driver, or the property market. It doesn't also want to rely on exports because you have demand in Europe and the US weakening. You also have, friendshoring and all those themes that we've been talking about for months and months. So it's really trying to revive the domestic economy, and that relies a lot more on the consumer and on households, and that's, sentiment is still incredibly weak there.
I mean, you could argue that the shift in the focus that you just outlined, Sphia, essentially makes kind of this argument that maybe China, and I'm going to get a lot of flack for this, I know already on Twitter, maybe China is actually pivoting away from being that traditional EM kind of country that we were talking about. And these are the kind of the shifts into services, into the focus on consumer, away from infrastructure that helps it kind of compete with other developed economies. A topic for another time, if we will. Bloomberg Sphia Horta Acosta covering all things China for us this morning. Let's go from China to the U.S. because again, one of the read-throughs is the big question. Is this something the Federal Reserve has to worry about? Well, economists at Goldman Sachs are looking at the Federal Reserve, and they're actually predicting that when it comes to monetary policy, they're going to start lowering interest rates by the end of next June. The Wall Street Bank anticipates 25 basis point cuts per quarter, but expects no more hikes to come this year. They say the cuts in their forecast are driven by the desire to normalize the funds rate from a restrictive level once inflation is closer to the target. Joining us now is Bloomberg's Valerie Teitel. Valerie, walk us through this call here, because I think it's pretty surprising that Goldman is actually pricing in cuts in 2024 when I feel like the market is now saying, well, maybe it's further out.
Look, I think the interesting thing, Kriti, here is they're calling for cuts, but it's not because they see the economy slowing down. It's not because of a hard landing. It is just clearly because they think the Fed is going to aim towards policy normalization next year. They see 25 basis point cuts per quarter from the end of June based on that desire to normalize the Fed funds rate from a restricted level to maybe a more normal policy level once that inflation is closer to target. To me, this was clearly prompted by last week's inflation print, which showed that month on month coming in at 0.2%, which if you annualize is below the Fed's 2% target. They do see, very interestingly, the Fed funds rate cut eventually to stabilize around 3 and 3.25%. So that's Goldman there throwing their hat in the ring on where they think our star is, where they think this neutral rate is for the U.S. economy, 3 to 3.25%. I would say it's above the Fed's expectations of 2.5%, but below where the market is currently pricing the long-term Fed funds rate at 3.6%.
What changes that, though, Valerie? I mean, when we have these kind of market strategists, the easy question to ask is, hey, you're bullish. What undercuts that opinion? Valerie, what undercuts Goldman's call here?
Well, they think that there's a risk that these cuts could come more quickly, and that is just underlying if the Fed becomes a bit more confident that inflation is falling back towards the target. But they do note, Kriti, that these cuts could also come not at all. They note that normalization, a policy normalization move, isn't necessarily an urgent need to cut rates. So there could be a risk that they have to keep rates higher for longer, and those cuts don't come next year.
Well, Valerie, all right, I'm going to tap into your kind of bond market expertise here. Roll with me. If we talk about cuts, essentially that kind of baked into that logic is simply this idea that the economy's kind of drastic slowdown, which again happens in every economic cycle, will come far quicker than expected. It's not going to be that gradual slowdown. It's not going to be that soft landing. It's going to be some sort of more dramatic drop. But is there really any evidence almost a year out from where Goldman is talking about these cuts to see that play out?
Well, look, you have to think that one of the reasons why the Fed could want to cut rates is just because there is no need to hold rates at this restrictive level if inflation is falling back to target. You can almost take growth completely out of the picture there, Kriti. If we're having inflation falling, if it is running at 0.2% month on month, what is the need to hold rates so restrictive? And I think that's what prompted this call from Goldman and is maybe having the market's eye taken a bit away from the growth picture, but just on this real yield story, right? The U.S.'s Fed funds rate is at a real positive territory for the first time in a long time. And is there a real need for that if we see inflation dropping this quickly?
Is there a risk, though, that we talk about the Fed potentially holding this rate at this restrictive level, as you point out, but we're seeing this resiliency that exists in the U.S. consumer and U.S. business spending as well? Is there a normalization of that higher rate? I mean, this is the entire kind of concept we had earlier on, which is a 2% inflation target even the norm anymore, or even the long-term norm? And Valerie, I know this requires a lot of kind of fiscal changes, a lot of legislation in Congress, but in terms of the actual economics of it, is it possible to have a longer-term restrictive rate just stay there?
Well, I think one of the risks to that, Kriti, is that this government spending, this Bidenomics, all of this government spending that we have seen does keep the economy stronger for longer and maybe does push up where that R-star, where that neutral level for the U.S. economy is. And I think that's one of the risks out there, perhaps, to this Goldman call, is that, you know, we're headed into an election year, Kriti. Governments like to spend during an election year. Democrats surely don't want to see a recession as U.S. voters go to the polls. So does that maybe boost to fiscal spending just push farther and farther out where the Fed cuts rates, because maybe inflation becomes a bit more of a problem? Maybe we see a resurgence in inflation because of that growth impulse from the fiscal spending from the government.
I love that you mentioned the fiscal spending. Valerie, you read my mind. This is why we have you on every morning. Bloomberg's Valerie Teitel walking us through the monetary and the fiscal story this morning. We thank you as always. Let's go from the macro to a little bit of the micro. The biggest deal news this morning, U.S. Steel rejecting a $7.25 billion takeover bid from rival Cleveland-Cliffs. It's going to begin a review of its strategic options instead. U.S. Steel announced a formal process to assess its alternatives after receiving approaches for parts or all of the business on Sunday, with Cliffs going public with its offer just hours later. Now, Cliffs did say it submitted the proposal privately on July 28th and received a rejection letter calling the offer, quote, unreasonable, despite representing a 43% premium to the steel maker's last close. Now, U.S. Steel confirmed the response but defended its decision, saying that Cliffs had refused to sign a non-disclosure agreement unless the Pittsburgh-based producer agreed to the economic terms of the proposal in advance. Now, of course, this is a really important deal because the combination of the two would help the likes of Cleveland-Cliffs really compete with the dominant players in the rest of the world, specifically that are located in China. We're going to ask the CEO about that at about 11:30 a.m. Eastern. The CEO of Cleveland-Cliffs, of course, joining Bloomberg Markets with Alex Steele and Guy Johnson. It's an interview you do not want to miss on the deal of the morning. Now, coming up, an unexpected win in Argentina as an outsider congressman upended this year's presidential race. More on that next. And later this hour, we're going to catch up with Sphia Salim, Bank of America's head of European interest rate strategy. We're going to ask her about that Goldman call. Is it worth it? Is Bank of America on the same page? What's the read through? All of that coming up next. Plus, we're going to hear from the author of Chip War, the fight for the world's most critical technology. A really interesting story as we talk about China, Europe, and of course, the highly expected ARM IPO. All of that still ahead. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Let's get to some news in the emerging markets. In Argentina, primary election results are in, with outsider Congressman Javier Milei pulling in a surprise win. Bloomberg's Manuela Tobias has more.
Argentina witnessed an absolute upset on Sunday night's primary presidential election. Javier Milei, an outsider third-party libertarian candidate, took 30% of the votes, winning as the highest voted candidate in the race. He outpaced the opposition coalition, who had, two candidates competing for the nomination, and the incumbent party as well. He outscored everything that the polls were expecting, which were pegging him at around 20%, no more. And it is just an absolute surprise compared with, as well, what markets were expecting. Milei has been compared with Donald Trump and Jair Bolsonaro. He represents his own libertarian party. Within all of the different market scenarios, a Milei upset was the least desired by markets. So this is likely to be received with fear. Investors like his economic message of slashing public spending, but he has an aggressive style and lacks any sort of party structure that would allow him to get the changes that he needs to make in Congress, over the finish line. He also we're expecting a sell-off, definitely in the parallel exchange rate that analysts say could be around 15-17%. We're also expecting bonds to drop lower on continued uncertainty and the expectation that this election could go to a second round. We have a general election in October, and that could go off to November now that this race has been divided in 3 parts. Manuela Toyas, Bloomberg News in Buenos Aires.
A live report there from Buenos Aires about a crucial election in the emerging markets. Of course, we will bring you all the updates as we get them. Now, coming up on the show, wheat rises as Russia fires on a cargo ship in the Black Sea. More on that next, and the commodity read-through coming up. This is Bloomberg. Let's turn to some of the stories that caught our eye around the world. Wheat edging higher after Russian Navy forces fired on a cargo vessel in the Black Sea. The carrier had been heading to the Ukrainian port of Izmail, but was fired upon when no response was heard for a request for inspection. Of course, you are seeing wheat futures rise on that news, higher by 1.2%. More ahead, this is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. China sets up a task force to examine risks and potential debt after one of the nation's top private wealth managers missed payments on multiple investment products. That, of course, alarming investors with fresh anxiety about the health of the shadow banking industry. And Goldman Sachs pencils in the first Fed rate cut. Economists there expecting the central bank will start lowering interest rates by the end of next June, with a gradual quarterly pace of reductions from there on out. And in deal news, U.S. Steel rejects an over $7 billion takeover offer from rival Cleveland-Cliffs that promised to create one of the world's biggest steelmakers, after calling the bid, quote, unreasonable. I'm Kriti Gupta in New York. Danny Berger is off today. Let's get a quick check on these markets here, because in the Asian session, you did see a lot of pain. You did see red, a massive sell-off, a lot of that coming from weakness out of China, concerns around the property sector. But then, hey, if you look at what the European market is doing, not that same sentiment crossing over. You actually saw a little bit of green on the screen there, and that is important as we talk about the European stock 600 actually getting a little bit higher. And on top of that, that actually flowing into the U.S. story as well. Futures higher by about 0.2%, 44.90 on that contract. And again, you are starting to see, we're going to go back to Europe here, outperformance in that German index. And I would argue that in the U.S. is a little bit different, because you're seeing outperformance in the tech side here. Now, let's talk about the bond market, because that's really where you're seeing a lack of action. It's interesting. The equity market is moving, given on that light trading volume, but the bond market doing something a little bit different. 2.61 is your number on that German 10-year. A slight bid in the terms of direction, but again, it is kind of staying fairly unchanged. If you look at the U.S. session, you are seeing it a similar story. Let's go to the commodity story, though, because nat gas is higher by about 1%. A lot of that coming off of concerns from those Australian strikes and what that means for LNG supply, natural gas supply broadly for the European continent as they're going into those winter months. And of course, Brent crude is also going to be an important topic here. You are seeing it trade about an 86 handle, down about 0.2%. So the commodity story gets really, really interesting as we talk about these global dynamics. Remember, we are also dealing with war in the Black Sea, where you're starting to see grains and oil start to get really affected by that dynamic between the Russia and Ukraine, and essentially the grain deal split apart as well. Not to mention the Iran prisoner swap as well. What does that mean for Iran oil cargoes entering the market? Now, all of this is going to have an effect on inflation, specifically in Europe, and that is going to matter as we talk about the global inflationary dynamics. Let's dive right into it with a true expert. Sphia Salim, head of European interest rate strategy, joins us over from Bank of America. Pleasure to have you on this morning, Sphia. Let's start there. You're seeing a lot of movement in the commodity sector. You're seeing a lot of concern about what the winter months in Europe might actually look like, not to mention what 2024 might look like. Is this the end of inflation? Let me put that to you. With the commodity risk that we are seeing, do we start to see another bump in European inflation?
Well, actually, investors don't seem to be thinking that way. So we surveyed a whole set of fund managers, fixed income fund managers last week, and found that actually in our FX and rate sentiment survey, we have a net percentage of investors who are expecting higher commodity prices in the next 6 months, net 17%. And yet their inflation expectations have moderated. For end of 2024, we now have 80% of investors who think that Eurozone inflation will be sub 3%. That number was just 55% last month. So it seems that this commodity these commodity pressures are not having yet an impact on expectations in the long run for Eurozone inflation.
Does that create a dislocation, though, when you look at the European kind of interest rate market? We'll get to the U.S. in a moment, but in terms of kind of pricing that in, how do you position for something like that if that is your base case for hypothetically 2024?
So at the moment, investors are long. In fact, they're even longer than before the sell-off. They have bought the dip in fixed income. And today in Europe, they are actually at their longest or most overweight position in more than 2 decades. So they are positioned for the end of cycle trade. I would say that it's impacted by these inflation views, but also the view that supply in Europe may not have much of an impact on interest rates. We tend to disagree for the near term. We are actually arguing that we may see a little bit more upside pressure on European yields for the next few months, because supply is going to be quite elevated in Germany and France. And if you put that in a context where data may outperform very weak expectations, we think there will be a bit more upside in yields before the rally can kick in Q4 this year.
I'm so glad you brought up the supply story here, because, of course, stateside, that is going to be a major concern about just how much this bond market can really handle that extra issuance coming out of the Treasury. But Sphia, talk to us about that from an ECB's perspective here, that's actively trying to tackle QT as well. I mean, can the European market actually handle that excess supply? How much of the plumbing story worries you?
Yes, that is a good point, because we are seeing actually a big change in behavior from the ECB here. The ECB seems to be in very much of a cost minimization trajectory and focus. So we have seen that they have increased or lowered the remuneration on minimum reserve for the banking system. And we think that in this context, they are likely to also start early PEP QT. They have so far committed to ending or continuing full reinvestment in PEP purchases until the end of next year. We think they will change their mind and start a roll-off in the middle of next year. And that, of course, yes, will put more supply pressure in the market. But the context matters. Near term, if global data continues to outperform the weak expectations, that supply may be harder to digest. But when we see rate cuts really at the door in 2024, that supply may be a lot more easily absorbed, we think.
Sphia, you're reading my mind. I want to go to rate cut next. Before we do that, though, I want to talk a little bit about the numbers. You're talking about potential losses coming from the ECB. Put a number on that for us.
Yeah, so on their APP portfolio, the ECB has recorded or unrealized losses at the end of 2022 of 400 billion, we estimate. And they are on an ongoing basis facing negative carry. This is 60 billion approximately of negative carry per annum. So what we think they will be doing is trying to reduce a bit the cost by reducing the remuneration of some of the deposits. They've done that in minimum reserve requirements of the banking sector. Now we think they will also be lowering the remuneration of government deposits, of foreign central bank deposits, but also at the same time trying to reduce the balance sheet, which we think they will do through PEP roll-off rather than active QT. Because for active QT, you're actually going to be crystallizing those unrealized losses. And we think this is the least favored option here for ECB in this context.
I mean, President Lagarde clearly has her work cut out for us, for her, Sphia. Let's go back to the rate cut story that you were just talking about, though, because, again, we've been discussing this theme throughout the last couple of weeks. And, of course, in today's trade, of course, Goldman Sachs penciling a rate cut for the United States in the month of June of 2024. Sphia, in terms of rate cuts when it comes to the European story, are they on a similar timeline, or is this really where in the next, say, year or so, you see Fed policy and ECB policy diverge more substantially? What do you think?
That's a very interesting question, because actually we were thinking the ECB will probably take a bit longer to cut rates. But now that we're also seeing the resilience of the US data, our economists have also pushed back the timing of the first Fed cut. So now we have them along the same trajectory. One more hike to come in September, and then the first cut for both central banks coming in June next year. And the cuts are natural in this environment because central banks are very much in a restrictive territory here. So just to slow down in inflation towards target should be enough to then get them to cut rates in the middle of next year.
Certainly a lot to digest and an interesting conversation to have on, again, a summer Monday, if you will. Sphia Salim of Bank of America, we thank you as always for joining the program. Coming up, we go from the rate story, from the inflation stories, to I think something that really feeds in. We're going to talk about chips and how that factors into the geopolitics. We're going to hear from Chris Miller, the author of Chip War, the fight for the world's most critical technology. All of that still ahead. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the Cleveland Cliffs CEO at 11:30 a.m. Eastern, 4:30 p.m. in London. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Now, I'm very fascinated by the chips conversation, the geopolitics that we're talking about. We talk about NVIDIA, Intel, the ARM IPO. But how does this all factor in, or is this a 10-year-long story? Now, folks, I've had this book on my nightstand for about 6 months now, and I have been obsessed with getting the author of it on this show. And that's what I'm bringing you this morning. Chris Miller, Director of Eurasia over at Green Mantle, and of course the author of Chip War, the fight for the world's most critical technology, joins us this morning. Chris, I want to put that question to you. I am fascinated by the chip story. I am fascinated by the geopolitics of it all. We are talking, or hearing, I should say, from President Biden and his administration to really domesticate a lot of this chips production. How far away is that independence that we're talking about, that deglobalization? How long until the U.S. can fully make chips on their own?
Well, the U.S. is never going to be completely self-sufficient in semiconductors. The supply chain is just too complex, too internationalized. But the $50 billion the Biden administration is spending will build a lot of new chip-making capacity, funding companies like Intel or Taiwan's TSMC to build new manufacturing facilities. And the goal that the U.S. has is to increase the share of chips that's produced in the U.S. Today, it's around 10% of the world's chips that are made in the U.S. The Biden administration wants that number to be 15, 20, 25%, which is substantially higher than today. and will take a lot of money to get there.
But that investment that you're seeing from the Biden administration specifically in the context of simply just how much this industry is valued, it feels like a drop in the bucket. Is it really going to be making that much of a difference?
Well, you're right that the industry's capex each year is huge, and government subsidies, though large, are small in comparison. I think if you look at the government subsidies next to shifts that are changing the way the industry thinks about investment patterns, and the big shift here is a decoupling from China, which the industry isn't happy about, but it realizes that as tech gets more politicized, it's got to change its investment patterns. And so the incentives the government is putting into the industry are really only part of the story. The other part is regulation. Government saying, here's what you can and can't do vis-a-vis China. That's changing how CEOs are thinking.
All right, Chris, let's talk then a little bit about the process of what it takes to actually increase that self-sufficiency. If not to 100%, then perhaps increase just how much we're able to create stateside. Talk to us about the labor involved here. I think I read a stat simply that although you are seeing cheaper labor, of course, on the entry level over in Asia, when you get to those mid-level or higher level roles, in the engineering story, you're actually neck and neck with American wages. Talk to us a little bit about the labor story there.
Yeah, that's right. Inside of a chip making facility, the jobs involved are very high skilled, very unique types of know-how. And so the reason that there's been so much offshoring in recent decades is not primarily about labor costs. The challenge the U.S. faces isn't the cost of labor. It's having engineers trained in the exact right disciplines that are needed for chip making. And right now, there's a huge number of programs being set up between universities and chip making companies to train a new generation of engineers that are skilled in semiconductors. And it's going to be a long time to undertake this training because there's really unique know-how that's required. And the U.S. has not been training the number of semiconductor engineers that it needs.
You know, it's interesting you mentioned that. Bloomberg Intelligence had moderated a panel with some of the C-suite over at Intel, and they said, look, part of their investment story from the money they're getting from the Biden administration is investing in the engineering story in the likes of universities that are close to the plants that they're building in Arizona, in, of course, the Northeast Corridor as well. But Chris, talk to us then about how companies broadly are positioning right now. I mean, you read these headlines about NVIDIA, for example, or Intel becoming the kind of anchors for the ARM IPO. Is that going to be enough in terms of kind of securing that vertical integration?
Well, I think that's part of the story, but companies are thinking a lot beyond that. ARM provides the architectures, the designs for semiconductors, but they're also thinking harder about the chemicals, the silicon wafers, and the assembly and packaging that happen at the end of the supply chain. And right now, you see companies that used to ignore their supply chain, think more, invest more, partner more to gain the resilience and security they need from the earliest stages of the supply chain all the way down to the packaging and shipping to customers. And that's where you actually have the biggest change right now in the bottom of the supply chain, where chips are assembled and packaged before they're sent off to customers. Today, almost all of that work happens in East Asia, and a lot of it happens in China. And that's where you have companies reducing their investment in China, trying to build up new assembly and new packaging facilities in places like India, Latin America, Vietnam, and elsewhere outside of China.
A lot of which I imagine is driven by those subsidies provided by the government, which brings me to the European story, Chris. We're talking about the ARM IPO, ARM, of course, based in the UK at the moment. But you've heard the likes of Emmanuel Macron, for example, and even Olaf Scholz talk about bringing a lot of this semiconductor capacity to Europe specifically. But if you look at kind of the amount of companies that are actually there right now, the only two major chip companies I can think of are ASML, of course, in the Netherlands, and the ARM graphic designing capabilities. Is Europe the future for semiconductors?
Well, I think Europe has a strong future in the niches where its firms are leaders. If you look, for example, at the production of semiconductors for automobiles, there's a number of European firms that have very strong market positions. And that's exactly where Germany is investing, trying to make sure that those firms have guaranteed manufacturing capacity, most notably via a recently announced joint venture with TSMC, the Taiwanese chip maker that's the world's largest. And so I don't think Europe's going to be a dominant player in the chip industry, but European governments are investing a lot to make sure that their firms that are players in certain niches retain their position.
All right, Chris, in our last few minutes here, let's talk a little bit about pricing power, if we can. It feels like when you look at the history of chips, and you really kind of go into depth about this in your book, this idea of shifting from Moore's law, essentially the ability to kind of cut the size of the actual chip itself, to something like the Internet of Things. Does that create a more expensive chip for the end consumer?
Well, prices have been falling year after year, but it's getting harder and harder for chip companies to find new ways to cut costs while adding new performance. One of the key changes you see right now in the industry is a focus on what's called advanced packaging, new ways to put chips together to add new capabilities onto semiconductors. And this is a huge opportunity for many firms across the industry, but it's also a competitive challenge because it threatens to upend the way that chip companies differentiate their progress. And industry leaders from TSMC to Intel are trying to develop new packaging techniques, market them as a key differentiator. But they face a lot of competition from newer firms and smaller firms that are trying to win market share based on their new packaging capabilities.
It's interesting that you mentioned that. I'm going to end here with the final question when it comes to EV, AI, et cetera. We're talking a lot about this run up in terms of AI and the data centers meant to power it. And even argue even the metaverse, for example, is a big part of that story. Chris, is the capacity pre-existing in the chip space right now to catch up to this massive investment we're seeing in AI?
Well, you see real deficits right now, in particular in the chips that are used to train AI systems, chips that are made by NVIDIA or designed by NVIDIA, but manufactured by Taiwan's TSMC. Companies can't get enough of them, and TSMC can't make them fast enough. So I think the next couple of quarters, we're going to see continued investment in chip making capacity precisely for chips used in AI applications.
So much to digest. Chris Miller, I could talk to you for hours. Thank you, as always, for joining the program. Chris Miller, they're the director over at Green Mantle. He's also a professor over at Tufts University, and most importantly, the author of Chip War, The Fight for the World's Most Critical Technology, a book you're definitely going to want to dive into. Coming up on the show, look at some of the market-moving events to watch throughout the week. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Let's take a quick look at what's going on ahead today. Overnight, we're going to get a slew of data coming out of China, more perhaps insight on what that property slump actually looks like. Then, of course, we get UK jobless claims and U.S. retail sales all on Tuesday, not to mention the retail earnings that come with it this week, kicking off with Home Depot and, of course, Target, Walmart reporting later in the week as well. We also have Eurozone GDP, UK CMI, and FOMC minutes all on Wednesday. And finally, we round out the week with Eurozone CPI and UK retail sales on Friday. So if you were worried about needing more data points in terms of the slump in China or even the slump in the UK, this week is your week. That's the macro story. Let's get to the micro here and look at some of the stocks we're watching in pre-market trading in the United States. It is the deal of the morning, or potential deal, I should say. U.S. Steel starts a review. It spurned a $7.25 billion bid from Cleveland-Cliffs. Now, these are two of some of the largest steel makers in the U.S. Cleveland-Cliffs, of course, making their name on iron ore specifically, but if, hypothetically, they were to be combined and U.S. Steel were to accept that offer, it could create one of the largest steel makers in the world, going neck and neck with some of the dominant players in China as well. U.S. Steel higher by about 24% this morning. Cleveland-Cliffs taking a step back, 6.7%. Another couple of stocks we're watching here, AMC and APE. Now, it's the same kind of company. AMC Entertainment shares down about 28%. AMC Entertainment Holdings, those APE shares, higher by 28%. The court approving that stock conversion plan. So seeing a reversal of some of the stock flows that you are seeing earlier. And of course, we got to get a quick check on Tesla here. They are cutting their Chinese prices again. A slump in auto stocks around the world. Now, remember, they had signed that truce back in July that really ended very quickly, ended before it even began. And simply, they were going to say no more price wars in China. Tesla not abiding by that, down by about 1.8%. And of course, keep an eye on those big tech names because you are already seeing a little bit of a retracement in the S&P 500 from its peak at the end of July. That does it for Early Edition, folks. Surveillance is ahead. Stick with us. This is Bloomberg.